Hey traders, this is Blake Morrow with Trader Summit. I have Jim Welsh. Now I try that one more time. Damn it. 3, 2. Hey traders, this is Blake Morrow with Trader Summit. With me today, it's Friday. I have Jim Welsh from Macro Tides. Jim, how are you?
I'm great. Hope you're doing well.
Yeah, I'm doing really good. It is Friday. It's good to see you. Hey, before we get started, I just want to say, guys and gals, if you are watching us on YouTube, make sure you subscribe to the channel so you don't miss any of Jim's great analysis that he provides each and every week. Subscribe to the channel. It's free. And give him a thumbs up, too, after this video. Tell him how much you appreciate him being here. All right. So, Jim, speaking of appreciation, I appreciate the volatility that we're seeing right now. We are seeing some hella volatility in the markets. You're seeing the euro kind of ping pong between 117 or 113.70s to 115. Have some big rejections there. You're seeing all these Fed governors and just talking and creating a lot of ruckus in the markets. How are you navigating through this this volatile period in the markets?
Sure. Well, as we talked last week, I thought the euro was ready for a pullback, and potentially you could retrace about half of the big rally that it experienced down closer to 113. That was a 50% retracement. So to me, the next one would be looking at the 382, which is probably as close to that in terms of the 113.70. In Monday's weekly technical review, I noted how much the dollar had dropped and that it was due for a bounce. And I think that's what we've seen this week, that bounce. But my expectation remains that I think the dollar is going to drop closer towards 93.50 over the next 1 to 3 months, which obviously should give the euro a boost. And I think it's, if it's 116.50, something like that, I'd have to look at the chart again.
Yeah.
There's some support that I would expect the euro to rally up to the underside of that support from, probably 2-3 months ago.
Yeah, it should equate to about the 116.50 to 117 in euro terms. Yep. Obviously, different currencies may respond differently to the dollar index move like that. One of the other things I've noticed is we had this rally in yields above 2%. Obviously, bonds have gotten absolutely smoked in the 10-year. I know you want to talk a little bit about yield curve, but what do you make of this? What do you make of this 10-year at 2%? Is it a big deal? I mean, it looks like the stock market doesn't care.
It's going to, in terms of how stocks respond. A number of months ago, I targeted a rally up to about 238 on the Treasury. From the lows of 2020, around 50 basis points, it went up to 176. Pulled back to 112. So an equal move would get it up towards 238. I think there's a shot that it's going to continue to press up in the near term for a lot of different reasons. And I think as that transpires, I think we're going to see the S&P struggle. More importantly, Blake, we're going to see economic reports for the month of January. They're going to be weak. And what happened last week on Friday, the employment report came out, 467,000. And people had started to worry about, oh my gosh, the Fed's tightening into a weaker economy. The jobs number came out and, we don't have to worry about that. Well, that number, as I noted again in the Monday weekly technical review, it's all based on adjustments that the BLS made. So was it a real number? Not in my opinion. So my point is people drew a lot of encouragement from the jobs report. I think that's going to be taken away. And in the next few weeks, we're going to see weaker data coming out and more Fed speak in terms of how they're going to raise rates. I don't think the market handles that well.
Okay. Well, before we before we get into the charts that you brought to me, I wanted to ask you about the inflationary data that we saw this week. Obviously, CPI was front and center on Thursday. Markets reacted, stocks came off as it was a hotter number, but all of a sudden, stocks rallied back. It seems like it's all priced in. We got all these rate hikes priced in. We've got, high inflation that's priced in, and people think that we're going to be peaking here over the next month. And stocks are still holding at 4,500 on the S&P today. So what do we do? I mean, I've had multiple people call me and say, hey, I don't know why stocks are up here. Why are they up here? I'm not too sure, but they are. It's like they factored all this in, they priced it all in. And here we are. So what do you do?
Well, again, I think people drew a lot of comfort from last week, we're not going to go into a recession, because there were some people starting to talk that. So I think that's why the buy the dip mentality is kind of resurfaced. I think that's going to go away as we get weaker employment data and the Fed continues to talk tough. I continue to believe that before a real low is put in, we'll see the S&P below 4223, which was the January 24th low. There's a chance, based on the pattern in the S&P, that we could see a pop above 4620 before the leg down commences. But the main thing is the Fed's going to keep talking tough, and people are going to start to get concerned about the economy when we start getting retail sales and a number of the key data points that will come out in the next few weeks. So I think that's going to be the big hurdle for the market. And my expectation is we are going to see yields continue to climb a little bit higher. Look at the 2-year, get up to 163. So here we have the Fed funds rate at 10 basis points. The 2 years at 163. I don't think the market has fully come to grips. Yesterday Bullard talked about a 50 basis point hike,
Possibly 100
by June. Well, no, 1% over 3 meetings, which meant you had 50 basis point. I did a podcast yesterday and I said, what's going to happen here is, the Fed uses forward guidance, which is why there's not going to be a surprise rate hike, intermeeting or any of that kind of stuff. They want to guide markets forward so that you don't get a dislocation. So my comment was that Bullard's talking about, 150 basis point hike, but you have other members on the FOMC board like Kashkari, Mary Daly out in San Francisco that are going to take a completely different view. So part of the Fed's forward guidance is to get markets ready to so they don't overreact to the news. So to me, this is all part of the dance of forward guidance. Bullard comes out, is pretty hawkish, and then you have other people saying, well, I'm not on that camp yet, and that's what we've seen this morning, which is why I think there's a decent chance, as long as the S&P holds the 4450 level, 4440, call it, that you could see a pop to 4620. In other words, it went from 4451 to the high yesterday, which I think was 4580 something. I don't know.
Yeah, something like that. Yeah.
So 150 point rally from the lows of this pullback that gets you, I think, somewhere around 4620. That I think will complete a second ABC rally. So you got a big ABC pattern from the January 24th low that I think is probably a wave B.
Well, since you're talking about this, maybe I should bring up the chart.
Yeah.
So here's the chart that you were talking about. So this is what you're eventually targeting 4100.
Under 40. Yeah. Right.
Okay.
Again, here's the idea that the first leg down was 595 points from 48.80 to 42.23. From whatever high we hit, equality would say, okay, another 595 point decline. So far, the high is 45.95. So that would target 40. Hang on. Okay, sorry, I'm getting some of the the springtime stuff. Okay, so that would target 4,000. If the S&P does manage to rally to 4620 or so, then you subtract 595 from that and you get a different target. In addition, if this decline starts to unfold, the length of the moves down can then provide a more accurate target as you approach a trading low. So that's my expectation, is that we're going to see the S&P drop below the 4223.
Wow. Okay. Then that's eventuality, but we're going to see a little bit of a pop here first, right?
Yeah, I think potentially, as long as we hold 4450. Man, I'm going to try to sneeze here, and I'm sorry. What was I going to say? Once this low is in place, I think we see new all-time highs.
Wow.
Second half of this year. So I want to put that in the context.
Oh.
And the reason is, I don't think we're going to see a recession, which leads us into the next couple of charts.
Okay. Yeah. Let's talk about that. You brought the 2 minus the 10. What are we looking at here? I mean, everybody's talking about this yield inversion.
Inversion.
Yeah.
Yep,
what's going on?
So basically, the yield curve normally slants upward, where in other words, the 2-year would yield 1%, let's say, and the 10-year would be at 150, 180 or whatever. So you have a positive number. Yield curve inversions occur when the 10-year drops below the 2-year. So on the chart we're looking at, you see that zero line. Whenever the line that's charting this dips below zero, that means that the 10-year now is below the 2-year. And the thing I would point out is prior to every recession, and this is why there's so much conversation about it, it is a really good indicator in terms of presaging a recession. Going back, this just goes back to what, 1975, you can go all the way back to the 50s, and this pattern shows up. So my point here, Blake, is two things. One, the yield curve is at about a plus 50 basis points right now. So we're not even near zero yet. And yet a lot of talking heads, oh my God, the yield curve is going to invert. The other point, which is almost as important, is the lead time, average lead time between you get an inversion and then a recession. And on this chart, the recessions are that shaded area, vertical area.
Yeah.
Is an average of about 19 months. So my point is, is this a good indicator? Yeah, the lead time is really very significant. So I just think people are over their skis talking about a yield curve that hasn't even happened yet and has a lead time of 19 months.
That's funny. I've heard the over your skis comment actually twice today. It must be ski season somewhere. So what's the next chart that you brought up? I can't help it. I'm sorry. What's the next chart that you brought up?
Okay, leading economic indicators, which is a composite of 10 indicators, individual that they put together. Conference board puts this together. So the thing I want to show here is this is the lead time prior to recessions. It's not the actual indicator. In January, the leading economic indicator made a new high, recovery high. So it's still trending up. What this shows is how many months prior to a recession does this thing peak and start to turn down? The median is 10 months. So it too is still rising. And it has a lead time of 10 months. So to me, the two indicators that have been most reliable going back 60 years in foreshadowing a recession are still very, very positive. And you have a lead time of at least 10 months. That's why I think the recession talk is way overdone. Consumers have over $2 trillion worth of savings. Wage growth is up. So again, I just don't believe at this stage that the recession talk is more fear-mongering than actuality. If that proves correct, that will provide the justification, I think, for the market to rally. Because my other assumption here, and I've discussed this at length and written about it, is that I thought the CPI would continue to go up in January and February. So yesterday's number, not a surprise. But the mathematics start to kick in as you get into April, May, and June. We're going to see the CPI come down. So I think that's going to be one of the backdrops of, oh, okay, so the Fed doesn't have to do 50 basis point increase or 7 in a row, which is now being bandied about. They can be more measured. So again, my take has been get 3 rate hikes, the March, May, June, inflation starts to come in. That should take some of the, the anxiousness that we're seeing in the volatility in the markets start to ebb. And again, that provides the framework for the S&P to make a trading low and then subsequently rally to new all-time highs in the second half of this year.
Wow, we're going to leave it on that because that's exciting for many of us. Jim, I love what you do. I love how you marry the technicals with the fundamentals and the macro backdrop. So if I'm a trader, I'm listening to you. How do I find out more about what you do?
Macrotides.com. And if you want to get, for instance, a sample letter from this past Monday, the weekly technical review, shoot me an email, Jim Welsh, WELSH, @gmail.com. And I'm happy to send that out to anybody who would like to take a look.
All right, Jim. Well, thanks for joining us today. I always look forward to our Friday chats. I hope you have a great weekend. I know most people are going to be listening to this after the weekend, but I hope you guys have a great trading week and give Jim a thumbs up for everybody. Smash that like button, as they say. All right, Jim, have a great weekend.
You too, Blake. Thank you.
Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.